So we had a really busy week this week, news-wise. We had some economic numbers that were important, meaning the durable goods orders and also some GDP revisions. We had some Yellen action. We also had an unexpected stepping down of the Speaker of the House, John Boehner, and the list goes on. So let's start from the top with the macro view. The durable goods orders were a miss. They weren't a complete disaster, but they were pretty crappy. A lot of that is a read into Boeing, and durable goods are really important. I mean, we saw Caterpillar got slammed this week. Boeing is doing like okay, but the orders aren't that great. So we had a GDP revision today. This was the third revision to Q2 GDP, and it was another revision up, which is good. I'm very glad to hear that we had a good second quarter. The TV and the media leave out that this is all rear view mirror stuff, and China meltdown and the Brazil meltdown and the weakness we've been seeing, the deflation that has been coming from overseas, hasn't really washed up on our shores in terms of that data. There is some stuff that is showing me that it is starting to affect us, and I'll discuss that. The Atlanta Fed, which is Lockhart's home turf, lowered their GDP estimate for the third quarter yesterday. That was sort of not reported on, but that's one thing. You could already see the Q3 revisions are coming in, and they're down. We also had, I'm trying to figure out how I want to, which way I want to go with this. This is the beauty of live broadcasting. But we also had Chinese, their flash PMI was negative. It was 47. It was a miss of even the 47.5. Anything below 50 is contractionary. We know Brazil is in massive smackdown mode. The market there is, believe it or not, the ETF here, the tracking EWZ, is below the 2009 crash lows. There was a little bit of a reversal in some of their currency. It was pretty disgusting, actually. So maybe the low in Brazil is in for a little while. We'll have to see how that plays out. My concern, though, and I've been discussing the deflation that I can see washing up here, and I had tweeted this out last night late. Some of my best tweets are late. You think the regular trading hour stuff is good. You should see what goes on at night. The Walmart has now realized that the yuan in China has been devalued, and they're starting to ask their suppliers, their vendors, for discounts. They want them to pass those discounts along to end customers. Now, the problem with that, as we know, is that's deflation. I'm trying to just turn this little pinging sound off, if you just give me a sec. This isn't going to stop, is it? So let me just shut this off. It's going to drive us nuts the whole time. I have a group chat going, and these people are just not relenting here. There we go. Do not disturb. Perfect. Okie dokie. We're all set. Sorry about the disruption. Again, the benefits of live programming. So this really is concerning, because if Walmart is asking for that,
air is cleaner.
What the hell is going on here? Sorry, this is like total amateur night here tonight. The Walmart asking for that could be Walmart is a leader. It's a big employer. It's a big company. A lot of people look to it as the model going forward for other companies. They sort of took the plunge with regard to raising minimum wages, which is also a multiple contractionary event. So if companies are going to start getting squeezed more by Walmart, if prices contract based on Chinese devaluation, that could start having a ripple effect throughout the economy. A lot of the benefits I see that are coming from some of this deflation, and I've discussed about this for a while, is that energy prices have been stubbornly high until recently, and I think a lot of that has hurt Europe and these Asian countries because they're major importers of oil and natural gas. The United States, I've proposed, has benefited tremendously from benefits in technological advances in hydraulic fracturing as well as horizontal drilling, and a lot of the decline in the price has actually come from the increase in the supply, as well as the Saudi Arabians competing for market share. What isn't discussed, though, is that there is also a demand. There is demand destruction. When prices are high, at some point people can't afford it. They'll use less. You know, if you're paying $1.50 or $1.87 to use your car, you know, per gallon, you'll probably drive a little bit more than you would if the gas was $5 a gallon. You know, it's just simple laws of economics. As price goes down, demand goes up, and as price goes up, demand goes down. Simple economics. And the truth of the matter, with oil prices, with stock prices, with any prices, the cure for low prices are low prices. We haven't been able to really experience that because we've been in I don't want to say a land of make-believe, but we've definitely been in because that would be, I think, just be a little bit too glib, and it would be too cute. You know, companies are earning decently. They've done a lot to improve their businesses and their capital structures. A lot of them have delevered. They have, or they've levered, and they've done it at very low interest rates. They have benefited from offshoring. They have fired workforces, entire swaths of people, and they have put them overseas for much less. They have bought back lots of stock. They will pay out dividends. The issue here is it's just company when the vicious circle starts, when companies start firing, consumers have less money to spend, thus another round of layoffs, to increase their corporate profits. I think the Fed is acutely aware of this. In Yellen's, not this past speech, but her last testimony in front of Congress, she talked about technological advances, which is structural unemployment. And I don't want to go over, I've discussed this a lot in other Periscopes. I'm starting to feel a little bit repetitive with this. I'm sure plenty of, there's definitely a lot of new viewers here, but if you're really curious to hear about this, maybe go back and look at some of those older Periscopes. But the point is that the economy is not well. There are a lot of rounds of layoffs that have happened and maybe more to come. Like I had said, Speaker Boehner resigned today. I believe a lot of that is because the Republican caucus is looking to fight it out with President Obama over Planned Parenthood and a few other issues that they take underway. One of the things, though, that is in there that isn't talked about, I think I heard it once on TV, and I read an article about it earlier today, and that's the Republicans spoiling for a fight to shut down the U.S. Export-Import Bank. Now, that's very important to companies like GE and Boeing and Caterpillar, companies that rely on foreign companies to buy products and also for financing of those products. If that shuts down, the truth is that a lot of those earnings estimates will have to come down. Maybe that's why GE has done a big round of layoffs. I know the Boeing CEO doesn't sound like he's very prepared for this because he just said he believes that it will be renewed. That is a big thing to keep on the horizon. If that export-import bank is closed, that could lead to a round of earnings estimate cuts, all within the backdrop of a slowing global growth. So enter Janet Yellen. I hope she's okay. She looked like she was struggling a little bit yesterday in her speech. She seemed a little bit sick. She blamed it on dehydration. At least she didn't have instant messenger going off in the background here, distracting her Periscope. So Janet Yellen said she thought it would be reasonable that the Fed would raise interest rates this year. It's sort of the first time that she's been, I guess, hawkish. Her speech was rather hawkish. The issue I take with that, though, is Yellen is predicating that on the data being good. And we know that the Q2 data was good, but we don't know that the Q3 data was going to be good. We had a little bit of a glimpse into it, though, I will say, which does spoil the thesis slightly, with Nike having very good earnings, and they had really blowout numbers in Europe and Asia. China in particular was just stellar. By the way, I still think that company can be a buy the dip stock, but only on dips. You know, we're in a really slippery slope market. You don't want to chase anything when it's up big. You want to wait till it comes in. And there'll be an opportunity at some point. You know, there'll be one of these open down 100, days, and, you'll have an opportunity to buy Nike. Anyhow, the point that, so anyway, you turn on the TV today, and everybody, it's a love fest. All these geniuses who have been wrong about interest rates the entire year and are still kind of wearing the egg on their face from the last go-around when I said lower for longer, and they were all saying hike. We're out again this morning, the same nonsense. You'd think they'd have learned their lesson. But no, they were, talking bearish about interest rate hikes. And the reason I don't think we're going to have hikes is because the data isn't good. You had a massive deflationary event happen in Germany this week with Volkswagen. They, originally I said on Periscope, not Periscope, on Twitter, that I thought the VW incident was a lot like BP, but it's actually much worse now that I think about it, and I've done a little bit more work on it. BP, was of course negligence and an accident, but this was a deliberate attempt to circumvent regulators. And the German economy, I think I've heard even numbers up to maybe 70% rely on auto exports. Mercedes, BMW, Audi, and of course Volkswagen. I don't know why I'm sounding fancy pronouncing it, Volkswagen, right? Anyway, they are going to have a lot of problems now. They are going to, every single Porsche, of course, too. Every country where these cars are sold, the DOJ launched an investigation. I'm sure the European Union is going to launch an investigation. This is going to be a trickle-down effect. The people who make the tires, the people who make the seats, the people who make the steering wheels, the people who make the HVAC systems that go in. These VW, I fully expect they're going to be paying huge fines. They're probably going to have some layoffs, and they may wind up having to produce less cars. So there is a lot of risk there. You can see Germany is down rather big. Our neighbors to our north, Canada, they are in a recession. So we're sort of like the only beacon with stall speed growth here, and that has put a lot of upward pressure on the U.S. dollar. So if you take a look at the dollar chart, I'm just going to pull that up right now. It's staying stubbornly strong. It's still within kind of the tolerance range, but if you take a look from the last low, we're starting to make lower highs and higher highs and higher low off of higher lows. That is a very, very dangerous pattern to be in with the dollar, because as other countries are devaluing their currency, if you take Yellen at her face value and she's talking about maybe raising interest rates, that would be very bullish for the dollar and be absolutely a disaster for U.S. earnings. Companies, as they do business overseas, if you listen to these conference calls, Caterpillar discussed it, even Facebook, for crying out loud, cites. That's why they always have trouble on their earnings calls, right? They're always talking about currency issues. So if companies, the quality of their earnings are coming in and they're earning less, the truth is, and of course interest rates are going higher, the price to earnings multiple that managers are willing to pay for those earnings is less. So that is a very, very dangerous zone that the Fed would be in, wanting to hike interest rates while other countries are devaluing their currencies. They'd be doing a de facto tightening and strengthening of the U.S. dollar when it's already strong. The Fed should be really acutely aware of this. Yellen just discussed this. I don't know why her comments in the press conference were as hawkish as they were, and this speech was rather hawkish also. I've been of the opinion that the Fed is trying to manufacture a controlled correction, and my answer to that is that Jurassic Park will never be safe. They always think that they can contain the animals, and then they get loose and they start eating people. So, animal spirits cannot be contained in a controlled manner when it comes to the stock market. They are, they're bullish and bearish forces at play. There are algorithms, and I believe that that has also been part of the weakness here. So not to flow too quickly, but I was on the Shadow Trader Uncovered show today. I did a call in with my buddies over there, and I discussed that the algorithms play a larger role in the market than I think people are aware of or they're willing to give credit to. So let's take Gilead, for example. Let's talk biotech. Everyone wants to talk biotech, right? It's a real sexy sector. So on 8/24, this was really rather ugly. Gilead had closed the prior day. It had been weak the prior day, believe it or not. It had closed at 105, and the next day it made it down to 86. Not on earnings, not on anything, just on a crash, a stock market crash. So that 86 number is now in people's heads. Algorithms are programmed by people. Traders are people. They trade on emotion. And I think they saw that 86 print, for example, and they said, why am I paying $100 or $105 for this junk when I can have it $20 lower? So I believe that the algorithms log those levels, and some other stocks have already retested those levels and even exceeded their crash low. I think United Technology, UTX, has already taken out that low. Yep, they are below there. They made fresh lows yesterday. Today they had a bit of a bounce, but not all that convincing. But Gilead, for example, could revisit that level. It stopped today just ahead of its primary trend. Believe it or not, even on the flash crash day low, it still closed above the primary trend. So we are testing into that range. I believe that it's looking a little bit weak. I like put ratios on that as it comes down into weakness. And then as we get down to like that 80, that 84, 88 breakout, 80 to 86 flash crash low, then I think we can sell some near dated, out of the money puts to play for either some chop and some stagnation or for a bounce. I would also be happy to play it with shares, right or right out with a tight stop, or if you want to buy calls or whatever. The one danger I would say about buying the calls in that instance is that the IV is going to get high as it comes down there, particularly if it's hard and fast, hot and steamy, whatever, hot and heavy. So the puts will be jacked. So selling, you might be able to sell further out of the money and get more juice for them than would be normal. So that I like. So why are biotechs having so much weakness? There's a gentleman, I believe Kyle Bass, he's trying to remove some of the patents from these stocks. I know he's been targeting some of the smaller, the weaklings, but also Celgene. And there were some comments this week from Hillary Clinton that she wants to limit some of the profitability of biotechs. But the truth of the matter is that the why doesn't really matter. It's the what. And the what is the chart. The biotech IBB, and I will show this in detail. If you follow me, you probably have seen the weekend review videos. I will show you the chart here and show you why this broke down, and you'll realize that it has really nothing to do with any of the BS that's out there. It's all technicals and price. The whys are important, but the truth is that the whys always follow along the line of least resistance. If a stock is in a down pattern and it has big news coming out, the chances are the news is bearish. Or if it's bounced and it's looking for more, the chances are the news is bearish. So the news, of course, for biotech was bearish. So it came down. The 61.8 Fibonacci retracement on that is 281.32. The flash crash low stopped just ahead of primary trend at 284.16. I would say somewhere between 290 and that 281 would be a good area to play right or right out. If you want to play it with put ratios near dated, like expiring next week or the week after, be my guest. If you want to sell puts into that, if you want to try, buying it BTD or whatever, that's fine. If that area gives and it breaks, then we're talking about a whole other story. And I will do an update on that on the stream. But I do believe that area will set up for some type of a bounce. It's starting to get pretty steep. We've had a couple of... Yesterday, we actually bounced off of an area that I had discussed. Again, I don't want to get too into this to steal from my Sunday Night Thunder. But today's price action was pretty bearish. I'm not a big fan of that. Not to be too pessimistic here, let's talk about a little bit of optimism. Nike had an amazing quarter, as I had mentioned, as did J-Bill Circuit. J-Bill Circuit, the last time around, it's probably a stock most of you haven't heard of, got absolutely destroyed based on weak mobile sales, and they did really well this time. So Apple did a supposed record build of 90 million iPhones. They are releasing into China for their first time on launch. So we're not going to get an apples to apples, so to speak, comparison, no pun intended, on their earnings report, but I do expect their numbers to be pretty good given Nike and this J-Bill number. So the key to Apple, and I don't want to steal too much from my Sunday Thunder, is it needs to reclaim 115. It was trying today. The market selling toward the end of the day was just too much to overcome, and it closed weak. So anything below there to me is still vulnerable, but up above 115 is good to probably to 119. Anything below 115 is vulnerable to 109 and potentially 103 and potentially even lower if we get ourselves back into crash mode, but I will discuss that on the weekend review video. And I'm a shameless self-promoter and tease of that weekend review video. So what are some of the other issues to be looking at here? The silliness stocks, as I refer to them as. That's a really good gauge of market sentiment. And I've been really, really bearish on them with the exception of starting to ease off the pedal on GoPro, although I still believe 28s are possible. And eventually, longer term, I think that stock is going to single digits, but before then it may want to rally. It's kind of the cheapest of those stocks. I'm just looking at it here. Today it was trying to do a little bit better, but it wound up closing pretty bearish. But some of the other ones, like Ambarella, really ugly, disgusting engulfing pattern today, closing at new lows. I still think that wants to see the 52.78, 61.8, and potentially even 48.5 to retrace the entire move and maybe even and then some. I like that now with put ratios or with outright shorts, frankly. But you don't want to do it on a decline. You want to do that on a into bounces. It had the bounce up to the 75s that failed pretty quickly. That had been some support, became resistance. It was also really kind of the launch pad of where the big move took place, the blow off top. I believe that the stock wants to come a little bit lower. Today it snapped. A couple days ago it snapped, and that 75s, by the way, was a failed retest of the backside of a tertiary trend line. Today we snapped the secondary trend line. Believe it or not, and I know I'm going to get a ton of hate with this, that the real true breakout of Ambarella and where the primary trend line is right now is 36.49, around 36.5. So I believe it's possible for Ambarella. It's probably not going to happen Monday, but over time might want to work down that low. And that is a pretty big ass kicking even from here. So I would be really careful with these silliness stocks. They're trading at really high, still even amazingly, even after these breathtaking declines, they're still trading at really high PE multiples. Now, there is an open gap in Ambarella that is up around 89. I don't know if that's ever going to be filled, but you might want to set an alert if that is ever filled. Somewhere between 89 and 96, I think, would be an amazing gift if it ever got back up there to short the piss out of this thing. I don't necessarily think it's going there so quickly. I think it has lower to go before it would go higher, but you never know. Lightning sometimes can strike twice, potentially if the market has some type of a further correction. So like if you were to get in there at like 36, you might want to ride it up for a bit. So that is that. The cybersecurity stocks. FireEye is one I've discussed, and then Palo Alto. So the FireEye pattern is pretty bearish. I'm just looking at this chart. I actually haven't looked at this in a couple of days. The last couple of days broke down, and guess what? Guess where it's looking to retest? That 824 low. Shocking, right? That to me would be a good area. I like somewhere between 29 and 30 to try this thing for right or right out. I just want to look at this on a bit of a longer time frame. I'm only on 9 months now. Yeah, I think that area looks like there could be some room down to these 27s. But I think down there, somewhere between the 27s and like the 30 area, I'd be interested in selling some puts on that. I had started to feel that the stock was getting really heavy into like the later part of the top. I think I sold it a couple of days a little bit too early. I think I had gotten out. I'm just looking at it. I don't remember the exact price. This is already a while ago, but it was much higher than it is now. It was definitely in the 50s. And I think it was like when it retested that channel top, it actually pierced through for a couple of days and got like $5 or so higher, or like $4 or so higher. But it proved unsustainable, and it's wound up pulling back quite a bit. The 61.8 tried to hold, but of course we had that flash crash low. I'd be interested in selling some out of the money puts where that flash crash low was. I don't know if these stocks have really, the stories are still good. I don't know though if the stocks haven't just about topped out though. So you might want to be a little bit careful with that. Palo Alto has held up much better on a relative basis. However, if you look on a daily chart, it could be setting up for a head and shoulders top here. It's really cockeyed looking because the stock had broken down so much. It's fared the best out of all of them. I believe it is still the best out of all of them. It's got a lot to kind of prove here. What got me nervous was the snap and the failed retest of the 50-day moving average, and that's when the wheels kind of really came off. So it's now back above, and it kind of held. I shouldn't say kind of. It did hold the 50-day moving average. This one may or may not be covered in the weekend review, so I will finish the analysis here. 50-day moving average is the must hold. If you lose that here, and that reference low of like 76, 79, just GTFO, because this thing is probably going to have a lot lower to go, and it would be now off of a lower high. If that's the case and this really collapses here, be really careful. It wouldn't shock me, though, to see some type of a Fibonacci extension. If it does firm, I could discuss that at a later point. But I'm not necessarily sure that's going to happen. But against the 50 MA, to me, is what's really key. Someone had mentioned this Mobileye before. Again, one of these silliness stocks. What do I mean by silliness, by the way? I just mean that there are stocks that, other than in a bull market, are ridiculous. Like, they trade at these crazy PE multiples. They sort of are up on a lot of hope and pray for future potential of what could be, and they don't do well in bear markets, and we are in a bear market. Sorry, I know a lot of people don't believe that, but we are. When a market makes lower highs and lower lows consistently, if a market drops 1,000 points in a day, that's not really bull market material. Sorry, being down 1,000 points, 100, not 14 points on the S&P, but 140 points. That is just breathtaking. And, again, to circle back a little bit to the Fed has tried with QE to remove volatility from the equity markets, and I think any risk assets in general, just because people have been so afraid since the 2008 and 2009 lows. Whenever we get a pullback in the market, everyone's like, oh, it's going to be 2008 and 2009 again. And that's a phenomenon known as recency, just meaning that we place more emphasis on events that have taken place recently than maybe historically. So I don't necessarily know if the wheels are really going to come off the market in the way that a lot of people are afraid they are, but I have proposed the hypothesis before that we may need to retest the 2000 and the 2007 tops down around the 155 to 157 area. This move here, to me, that we've experienced, the one that was on 824 and like the subsequent bounce here and now the kind of rolling over, this is all just the first leg of a potential 3 to 5 wave move. And I don't want to be too much of an Elliott theorist, but this is sort of, you ain't seen nothing yet if this market is really going to roll over and become a full-fledged, crash. I don't know that it will. This could just be some chop, and this might just be sort of like the reset before the breakout. A lot of Wall Street firms are all very optimistic. They have these very lofty price targets for the end of the year. We're going to be in October soon. I heard a guy on TV the other day mention that October is known as the sort of the bear killer month. I'm sorry, but the crash in 1929 and the one in 1987 all took place in October. So I don't necessarily put a lot of emphasis on that seasonality. But I will say this, that if there is going to be a rally, it needs to sort of happen soon. We are, the longer we spend time below the 204s in SPY, and the longer we hold below the 197s, 197.86 to be specific, the more volume that builds up here, the more fatigue that builds in these failed rallies. What disturbs me is I see people on the stream, and I know they're well-intentioned. I think they just don't really understand fully yet the market that we're in. I think they still think it's 2013, and I think there was a lot of that last year. The market was very forgiving last year, and there was a lot of ability to get out of bad positions. It has been much less forgiving this year. And I think that they don't understand that you can't buy on green and then puke it. You kind of buy it when people hate it and when the fear feels the max. And when you're at some technical support levels, the market is all technicals these days, at least on an intraday basis. The chasing has been. I've never been a big proponent of chasing. There was a very brief period of time where that worked out very well, and I think people don't really understand that those days are sort of behind us at the moment. They will eventually happen again, but who knows when and where. The market has a lot of overhead supply. Any touch back up there, we've had 1, 2, 3, and they've all been met with selling, and it just seems to me that the big institutions had been unloading for a while, as evidenced by the MOC, and they continue to sell rallies. So I would be careful. Here is my caveat for that. Next week is the end of the quarter. Q3 is going to be upon us, the end, and we are going to move into the fourth quarter. And there might be some end-of-quarter window dressing to boost returns of funds that have not been doing well. So it wouldn't shock me to see if we have some type of a nice rally the next few days, next week. I'd be very cautious if you're going to, kind of fall in love, if you're looking for love. I would say next week is more kind of like your Tinder hookup rather than your, looking to wife up. So if you're looking to make some bucks on the long side and if the rally does start to materialize, I think it could be rideable for a couple of days into the end of the quarter, but then after that you got to be a little bit more careful. If we have a big gap down on Monday, that would be a good opportunity to do some right or right out long testing. Also use I would use that to sell put rate or to get involved with the put ratios that I often discuss, or if you want to sell some out of the money puts. But I do believe that I do believe that next week should be bullish. I could be wrong. If it's down, it's even more bearish than I had thought. But I do believe that the market could have a nice rally for the foreseeable couple of days. If it doesn't, like I said, even more bearish, and we could have a potentially an amazing washout. So just be very careful with your size. Again, this is what I keep saying. The key to this market is having the right size. I've been saying smaller size is very important. Having a idea of looking for smaller swings, meaning that you're not looking for as large of a move. You're looking for shorter, smaller price action. Think speedboat over battleship, and then also playing in a shorter time frame. If you're looking for a bunch of days, it probably isn't going to happen. And if you think something looks like it's going to break out, if they rally it up to there, it's probably not. So it's a good idea to take some profits. Playing for the breakouts has been tough. On the converse side, you can tell on the stream at points of a lot of pessimism. Some of the weakest hands I know yesterday were short, and I believe that's what led to the rally into the close, and then today's gap up. They're doing the exact. These are the same people that buy the highs on the up days. They also on down days sell the lows. They're chasing the short on the downside, and true short sellers, professionals, tend to be more disciplined. They use quicker stops. They don't play the hope and pray game. Retail doesn't really tend to play in that department as much. So it's more professionals, and there have been some pretty epic squeezes. So you have to be careful. It's all trade location. In a bear market, you want to short on rallies. And in a bull, I've always said that the best way to be long is to buy dips on a rising tape. And then if you want to be short, to short rallies on a declining tape. So we are in a bear market, so you would want to be looking to more short the rallies rather than buy the dips. There are some exceptions, there are some technicals, there are some intraday plays, but as far as like a larger position goes, you got to be real careful with that, because what seems reasonable and rational in the beginning winds up becoming, things usually get worse than that out of necessity. Margin calls for selling, various other reasons. Anyhow, I don't want to go press too much more into this, because this will start getting into more weekend review territory. I really try to shy away from the technicals here as much as possible, although this conversation has been dominated by it. I hope you all have a really good weekend. If you caught this or came in late and you'd like to see the full video, go to my YouTube channel, hit the subscribe button, and watch the rebroadcast of this will be up shortly. Right after I end this, I'm going to get the process started to get it up, so it should be up, I would say, in an hour or so. If you're not following me on Twitter, my handle is @JustinPulitzer. I post all the links to my videos there. I do a lot of tweeting. There's also some other stuff that I post on there as well, like some charts or some various other articles that I find interesting. So if you're not following me, follow me on Twitter. Anyhow, let's have a good weekend and try and enjoy it. The summer is winding down, and I guess that's kind of all she wrote. So that's my story. I'm sticking to it, and cheers.